Hello, sir. Very good evening, friends. I hope I'm audible.
Evening, sir.
Good evening.
Good evening, sir.
Very good evening to all of you. Yes, I think we are good to start. Okay, so yesterday we did the concept of IS 10 with you, warm up exercise, a very basic standard indeed. So today we're going to start with another standard with you, which is IS 37. I guess many of you might have already done that standard earlier as well in financial reporting. But of course, we're going to have a little different way of looking at the standard because, as I said, in SBR, of course, the stress is more on the conceptual part. So we need to be conceptually sound as well. And I guess today I'll also show you the kind of questions which are asked in a particular area, because IS 10 there is no question indeed. But then in terms of IS 37, there's been a few, I think 3-4 areas of questions which are asked on IS 37. But that would be later. First, I think we need to create a base framework for the standard. So let's begin the journey. So I am going to start with IS 37. The name of the standard is called Provisions, Contingent Liabilities, and contingent assets. A pretty long name. So this is the name of IS 37. So there are three key focus words in the name of the standard. The word is provision, the word is contingent liability, and the word is contingent assets. So there are a total of 3 terms in the name of the standard. Okay, so I guess can we request you to please put your cameras on? Better, we can see each other. I think that gives a little better feel. Okay, that's great. So we are discussing IS 37, where we're looking at provisions, contingent liability, and contingent assets. Now, I have a little bad habit, as you already know, of asking so many questions indeed. Let's do one thing. Let's, I think, first of all, show you a definition of provision. And then I think we'll discuss something. I'll give you a problem and let's get your insight. So before I explain anything to you, I am first going to show you a definition. I'll not explain anything. I'll just give you a case study, a small little case study. You need to give your analysis on that. So let me share the screen and you can have a look at the definition. All right, I guess you can see the definition of provision on the screen, right?
Yes, sir.
Just read the definition of provision. If you want, you can also read the definition of liability as well. Or even if you just want to read provision, that's also good enough. So do let me know once you have read provision, and if you want to read liability, you can. Right, if you have read, then I'm ready to put a question to you. Can I stop sharing the screen?
Yes, sir.
Okay, so let me, I think, put a question to you. Based on whatever you have understood of the definition, let me ask something simple and straight to you. Let's consider a time scale and let's say my financial year is January ending on December X1. Now let's say my company gets an electricity bill once every 2 months. The facts are very simple. My company is getting an electricity bill once every 2 months. So which means, let's say for example, I got my last bill on 30th November. So I will be getting my next bill after 2 months, which means I will be getting the next bill on 31st January. Now my question is that I am going to close my books of accounts. I will make my balance sheet on December X1. So my question is, what about the electricity consumed in December? Are you going to make, are you going to provide it in the books of accounts? Question one. And is IS 37 going to be applicable? Question two. Get the facts clear. The electricity bill is going to be generated every 2 months. Electricity is consumed in the month of December, but the bill is going to be generated on 31st Jan. So my question is, am I supposed to, record this December amount in the books of accounts? That is one. And is it going to meet the criteria of IS 37, the definition of provision? So the answers are going to be either a yes, yes, or a yes, no, or no, no, whatever.
Yes, sir, we'll record it.
Okay, so I've started getting answers, and I think majority of you are saying a yes, yes to both questions.
But it won't qualify for IS 37.
Okay, so you will record it, but it doesn't trigger IS 37, right?
Yes.
That's what he said. Okay.
Yeah.
Suddenly, after you said that, many people are saying a yes, no. Many people are saying yes, yes. The moment you said, that I am not going to trigger 37, everybody started saying a yes, no. So we've got mixed responses where we say, get the answer yes, no, and yes, yes. Okay, I'm not going to give you an answer straight away. I will definitely come back to this case study, but I think I first want to, look at the definition again, give you some concept, and then discuss further. Okay, let me, I think, first ask you a very basic question before I revisit on the definition. What do you think is uncertain, the past or the future? Uncertainty is attached to what? The past or the future? So I am getting inputs on this that it is attached to future. Absolutely correct. So I think now I want to, draw your attention to the definition back again, and I want you to have a very clear-cut look at the definition. It says a provision is a liability of uncertain timing or amount. The word is uncertain timing and uncertain amount. I don't know when, I don't know how much is the liability. When it says the timing, we do not know when this liability will trigger, and we do not know what is the amount. The uncertainty is both with regard to the timing as well as the amount. Now, before we go further into the definition, I think another question which I want to ask you. In this case, is the expenditure already incurred or is it yet to be incurred? I did not say payment. I said, is the expenditure already incurred or is it yet to be incurred?
Yet to be incurred, sir.
So one thing is very clear, that if the expenditure, you said yet to be incurred?
Incurred.
Incurred, correct. So when you say that the expenditure is already incurred, one thing is very clear, that IS 37 cannot apply. Because when you're looking at a provision is with reference to future expenditure. The first and the foremost thought which needs to be clear in the mind is, when you're looking at a provision, it is with reference to expenditure which is yet to be incurred. So therefore, this cannot be a case of provision. But yes, I will definitely record this expenditure because we follow accrual basis of accounting. Rather, let's do one thing. I'm now going to introduce you to three terms which you're already aware of, but I want to give you a little more clarity on those three terms before we proceed further. Now, there are three terms which are coming at the back of my mind. The term number one is accrual. The term number two is payable. And the term number three is a case of provision. And interestingly, all these three are liabilities. You know, if you read the definition of provision, it says provision is a liability. And even accrual is a liability. Even payable is a liability. All these three are liability. So what is a difference between accrual, payable, as well as a case of provision? Now hear me very carefully. I'll give you the notes later, but first hear me carefully. Let's analyze these inputs. If you've already incurred an expenditure, parameter one, if you've already incurred an expenditure, number two, invoice already received, parameter two, and the money is not paid, parameter three. Mind the words carefully. I'm saying the expenditure is already incurred, the invoice is already received, and the money is not paid. It's called payable. Do you need any kind of estimation, or is the amount already determined? That was the question. In terms of a payable, if you've already incurred an expenditure, you've already got the invoice and you did not pay the money, do you need any kind of estimation, or the amount is already known? Okay, I'm getting the answers in the chat box. That's right. The answer is already known. It's already determined. Can I say if the answer is already determined, then in this particular case, it is not, it is a simple case of, you can say in this particular case, it is simply a case of a payable. Next, the amount of expenditure is incurred, the invoice is not received, and it is not paid, then it is called an accrual. So look at the distinction. Amount already incurred, invoice already received, and the amount is not paid, it's called a payable. Expenditure already incurred, invoice not received, therefore not paid, it is called accrual, and we need to accrue it in the books of accounts. Do we need an estimation if I need to accrue this in the books of accounts? Like for example, in this case, is the expenditure already incurred? Yes. Is the invoice received? No. And therefore it is not paid. So do we need an estimation for this expenditure? Yes. But do you think it's going to be an easy task or a tough task to do the estimation? What is your thoughts on that? Yes, it is going to be easy task because in this particular case, we just need to see on an average basis what is your electricity bill. So we do need an estimation, but the level of estimation required is not going to be very huge. It is going to be a small degree of estimation. Now comes the third input, and that is if you say that the expenditure is yet to be incurred, it is a case of provision. So I'm now very clear with three terms. I'm going to say the sentence. You need to decide accrual, or is it payable, or is it a provision? Let me put three inputs to you. Decide. The expenditure is already incurred. The invoice is not received. Therefore, it is not paid. That's great. It is accrual. Wonderful. Next. The amount is already incurred, the invoice is already received, and but still not paid. And that's right, it becomes a case of payable. And finally, I think you know the third answer, the expenditure is yet to be incurred. Then what do you call it? Undoubtedly a provision. Okay, so I hope I am pretty clear with the three terms to you. Let's make a clarification chart so that the concept is done. Let's, I think, make a small little clarification chart to begin with. So I am just going to consider a small little chart, a column for particulars, and let's take three columns. One is for payable, one is for accrual, and one is for provision. So one column is for particulars, one is for payables, one is for accrual, and one is a case of provision. So this is just a clarification chart as a base to begin with. So I'm now going to put some questions to you. You can again give me your inputs. So let's, I think, begin with first of all, number one. Is it a liability? What do you say? Is a payable supposed to be a liability? I guess all three are liabilities, right?
Yes.
So we can say a yes, we can say a yes, and we can say a yes. That's a similarity between all the three terms. They're all liabilities. Great. Number two. I'm looking at the expenditure. In case of payable, is it already incurred or is it yet to be incurred? Can I say both for payable and accrual, it is already incurred? So I'm putting it commonly for both. It is already incurred. This is the similarity between the two. And of course, for provision, it is yet to be incurred. It is a future expenditure which is yet to be incurred. Great. Let's consider another one as well. And let's consider the case of invoice. Is invoice already received in terms of payable? And that's yes, invoice already received. And in terms of accrual, can I say not yet received? It is not yet received. And in terms of provision, can I say not applicable? I'll not say that it is yet to be received because it's a future expenditure. So the concept of getting an invoice is not applicable. Next, I'm looking at estimation. Do we need any kind of estimation for a payable? Invoice is already received. So any kind of estimation? No. In terms of accrual, yes, but it is a small estimation. In terms of provision, yes, and it is going to be a substantial, a huge level of estimations which will be required. And also, let's give you another clarification as well. Is IS 37 going to be applicable or not? If it is a case of payable, no. If it is a case of accrual, no. If it is a case of provision, yes. I hope you get the clarity of thoughts. By this comparative chart, you've got a clarity of a clear-cut distinction between accrual, payable, as well as a provision. Right? So far, so good. Let me know if you have taken a note of this, then I'll take the journey forward. Right, so far so good. I can take it forward, written it down, I guess. I didn't get any response on that. I assume yes. Okay, now, before we understand the concept of a provision in detail, I think I need to give you a little history in terms of the standard, because it is important to understand a little history. There has been one of the examination questions also where the examiner was trying to understand that do you understand why IS 37 is created? So you need that background which I'm explaining you. It is going to be applicable in one of the examination questions. Let's consider 3 years a T-shaped income statement. Let's say this is the income statement for 3 years. This is income statement year 1, year 2, as well as year 3. Now I'm just going to give you a very simple problem and you will easily be able to identify what I'm asking. Let's say the profit for the year 1 is 600 lakhs. Let's say the profits in the year 2 is supposed to be 400 lakhs. And let's say the profits of year 3 is supposed to be 200 lakhs. Look at the performance of the company and tell me, is it a good performance or is it a bad performance? Look at the trend in profit from 600 to 400 and then 400 to 200, and I think we got this correct. It is a bad performance, definitely. Superb. Let's do one thing. Let's do a little manipulation and try to convert this bad performance into a good performance. Let's say the company created a provision of 400 lakhs in year 1. Can I say by creating a provision of 400 lakhs in year 1, the profits of the year 1 reduces and it becomes 200 lakhs. Let's say in the 3rd year, the company says that this provision is no longer required and it goes for a reversal of the provision. When it goes for a reversal of the provision, the profits of the year 3 increases from 200 to 600 lakhs. Have I been able to change the trend from a decreasing profits to an increasing trends? Yes, of course. Don't you think so? If this is the kind of manipulation which I understand, even the industry will easily understand. The International Accounting Standard Board, understood and realized that companies were doing this kind of manipulations in the books of accounts. The companies were creating a provision when the profits were high. And the companies were reversing the provisions when the profits were low. Hear me carefully. They were trying to do what is called smoothing in terms of profits. The companies were aware that if they want to smoothen the profits, what they can do when the company earns a larger profits, you create a provision. And when the company is not earning enough profits, you reverse the provision. And the best part was that the companies were creating these provisions and the provisions were created completely on an ad hoc basis. There was no logic in terms of creating a provision except a manipulation in the mind. The companies understood that if they want to, create a good trend in terms of profits, let's create a provision when the profits are less. Let's create a provision without any parameters, just on an ad hoc basis. And the moment the company says the profits are going down, they will reverse the provisions, and the International Accounting Standard Board actually witnessed this trend. And they even call this as the concept of a big bath provisions in their analysis. They said that we are seeing that the companies are creating big provisions when they earn huge profits and reverse them. And they saw the trend being followed by many companies, and they call this manipulation as a big bath provision. So now, as a standard setter, if I know that the industry is creating provisions on ad hoc basis, then what should be my course of action as a standard setter? Should I introduce some parameters and tell the company that you can create a provision only if these parameters are met? I think makes sense. I need to basically tell the company that you will be able to create a provisions in the books of accounts only when you meet certain parameters. So IS 37 was created at that stage. And IS 37, which was created at that stage, they said that the companies are no longer going to follow the concept of ad hoc basis. IS 37 said, we are going to give you the parameters. If you meet these parameters, then you can create a provision. Otherwise, you cannot create a provision. So this led to the introduction of, you can say, recognition criteria. It led to the concept of recognition criteria, which was laid down in IS 37 to make a provision in the books of accounts. I hope you got the background clear in terms of why IS 37 was created. You need to be clear on the concept that the companies were creating provisions on ad hoc basis in order to, discourage the companies in terms of creating ad hoc provisions. A criteria in terms of recognition parameters was introduced in the standard. Great. So now the question comes into the mind that what are the recognition parameter? So I'm going to give you the recognition parameter, but in order to give you the recognition parameter, I am going to build this in terms of a step-by-step approach. Any guess? What am I going to call this step-by-step model as? I like it. We're going to create a KB's three-step model on the basis of which we will decide a provision is to be created in the books of accounts or not. Good. So first I will explain you the concept. Don't worry, the notes will come later. We'll take a good number of examples also to illustrate the concept to you. But I think first I need to give you the concept. We'll do good number of examples in order to illustrate the concept as well. So let me, I think, begin with the concept of KB's three-step model in terms of IS 37, that what is the recognition parameter. Now please hear me very carefully. I'll take a small example also along to illustrate the concept of the three-step model. We will have a step number 1 and we will take 3 sub-steps in step number 1. My first step is divided in 3 sub-steps. Then I'll take a step number 2 and I'll take a step number 3. Now let's imagine an example at the background. Let's say there is a company XYZ Limited which is in the business of selling, let's say, laptops. So let's say there is a company XYZ which is in the business of sale of laptops, and when they sell the laptops, they are also giving a warranty to the customer for a period of, let's say, 3 years. So the company tells the customer at the time of laptop sale that we will give you a 3 years warranty, that if anything goes wrong, we repair or we replace the laptop in the next 3 years. Let's take this example as a base and let's begin the journey. Now, when you're looking at whether a company should create a provision for the expected expenditure on the warranty, the agenda is, the basic thought is that the company made a sale of laptop, and since they've given a warranty, there will be some expenditure which might incur in the future to repair and replace. So the question is that does the company create a provision or not? So what I need to do in step number 1A. In step number 1A, you need to first of all identify the event which has already occurred. You need to see what is the event which will trigger an obligation to pay. Whether it is paid or not is a different story. But company has done something today due to which there might be an obligation which will trigger. Rather, I would say there is an obligation which may trigger or not. Mind the words. I want to see what is the event which has occurred, which is creating an obligation which may trigger in the future or not. Can you tell me in my example, what is the event which will trigger the obligation to pay? So would you like to help me? What is the past event? No, warranty is not the past event. Can I say the sale of the laptop is the past event? When you made a sale of the laptop, it was an event which triggers an obligation in the form of a warranty, correct? So I would say, if I were to define that what is the past event, I would say the sale of the laptop is the past event. It is very important to first identify what is the event which will trigger an obligation. Then when you say yes, there is an event, now you need to see, does this event trigger an obligation? You need to see that the event of sale of laptop triggers an obligation. It should definitely trigger an obligation. Now, whether the obligation will occur or not is a different story. Whether the customer comes to you for repair or not is a different story. But one thing is very clear, that the past event should definitely trigger an obligation as of today. The past event which has occurred should definitely trigger an obligation as of today. Now, when you say that there is an obligation, we can say obligations as per IS 37 is of two types. There is an exhaustive list of obligations as per the standard. The first obligation is what is called legal obligation. And the second category of obligation is called a constructive obligation. So you need to evaluate that a given event is triggering an obligation. Either the obligation is legal or the obligation is constructive. Now the question arises, what is a legal or what is a constructive obligation? Now, when you say the obligation is legal, legal means it arises on account of either law or it arises on account of a contract. The law of the country tells me that you are obliged to do this. It's a legal obligation. As a company, I entered into a contract and I am contractually bound. It's a legal obligation. So I'm going to call this as a legal obligation if the law of the land tells me to do it, or as a matter of fact, I entered into a contract. Can you tell me, warranty card given by the company, is it a legal obligation? Is the warranty card a contract which is entered with the customer where the company says, I am contractually bound to repair or replace?
Yes.
That's right. So I would say, in my example, the obligation of warranty is supposed to be a legal obligation. So the moment the company made a sale, we say the event occurred and they gave a warranty card, so they are legally obliged. There is another kind of obligation also, which is called a constructive obligation. The question rises, what is a constructive obligation? The constructive obligation is got two parameters. See the words I've written "and" in between. The constructive obligation has got two parameters, and first of all, let me tell you, a constructive obligation is something by choice. It is not something by force. A legal or a legal obligation is by force. But when you look at a contractual obligation, it is purely by choice. The company, based on the past practices, or the company, let us say, makes a particular statement to the parties, to the customer. So a company on its own accepts a responsibility. A company on its own accepts a responsibility. It says that I am going to do this. Nobody is telling them to do that. Nobody is telling them to do that, but they on their own say that I am accepting the responsibility. So I tell my customers, you don't like a product, you will get the money refund. Amazon on its website tells the customer that if you don't like the product, I refund your money. It is like accepting a responsibility by making a statement on the website. The refund policy of the company is more like, accepting a responsibility. You want a good business practice and you tell your customers that I am accepting a responsibility. You don't like the product, you get the refund. But simply accepting a responsibility does not trigger a constructive obligation. If you want to consider an obligation to be constructive in nature, what is also important is the parties to whom you accept a responsibility, they should have a valid expectations from you. They should have expectations that if you're telling them that you will do this, you believe that yes, they will do it. So another important element is a valid expectation. Another important element is it is called a valid expectation. Now, let's give you a very simple example to illustrate the concept of a constructive obligation. Let's say during election time, a politician makes a statement to the public at large that if I am elected, I promise that I will do these things. Is it accepting a responsibility? During the course of election, you tell the public at large that if I'm elected, I will do all these things. I promise I do all these things. Is it accepting responsibility? That's right, indeed. The public sitting at large, they say, he's saying that, he will do that. Is it creating a valid expectations on the part of the other party? The public which listens to the politician say, if he says he's definitely going to do that, it definitely creates a valid expectation. Since both the elements are present, it becomes a constructive obligation. But let's say the public sitting at large say, he is not going to do this. He always makes statements of these kinds, but I don't think so he's going to fulfill those promises. It does not create a constructive obligation because both the elements need to be present. The person, the company makes a statement, has got a past practice through which a responsibility is accepted. But at the same time, the people who hear that statement, they should have valid expectations that they will do it. Let's try a tricky one now out here. If I say that I'll make you experts on SBR, am I accepting a responsibility? Yes, of course. Am I creating your valid expectations? Say no. Say no. And if the valid expectation is not created, I do not have any constructive obligation towards you. I hope I made my point of my constructive obligations clear. Thank you. Okay, so that was on the constructive obligation part. So when you look at the obligation, you need to see that in a given case, is the obligation legal or is constructive? Are we clear with the step number 1B? Are we clear with the step number 1B, I guess? Great. Okay, now let's go to the step number 1C. I think today everybody has chosen not to speak on the mic. Any specific reason? I think everybody is being silent on that. I found it a little surprising, but any specific reason that you put your mics off? Don't want to say anything? Mic is not working. Really? But I think few people were saying. I did not do anything actually. Try this now. I think it should work. Is the mic working now? Still not working. I didn't do anything actually. Now try this. I think it should work now. issue is at my end. Nobody's my mic is working, is it? Are you serious? Nobody can unmute yourself. Your mics are not working. Nobody is writing a yes or a no. How am I supposed to make any kind of judgments? It's not working. Host is not allowed. I am the host right now. Just wait a second. Let me just, I think, do the needful to you. I think it should work now. If it is same issue, I don't know, then something has been done. It
So
was
now it's
working.
working.
I
No,
have
sir.
full
Now it's
silence.
working, sir.
Great. Too much silence is very scary indeed. In a live class, when you can't see people and you can't hear their voice, it seems you're teaching the camera all throughout for the next 3 hours. Okay, good God. So are we clear with the agenda so far? Are we clear with the step number 1, A and B? Yes?
Yes, sir.
Great, wonderful
Yes,
indeed.
sir.
Okay, superb. So step number 1A and step number 1B is done. Now comes to step C. Don't worry, we'll do a lot of questions as well. I'll give you the notes also very soon, but let's first understand the larger concept. So you need to see that there is a past event which gives rise to an obligation. Then you need to see the probability. Then you need to see the probability of occurrence of this obligation. In step number 1C, you need to see the probability of occurrence. So will the question give us the probability of occurrence? Maybe, maybe not. We'll see that in the question. But for the time being, let's assume it gives you the probability of occurrence. So if the probability of occurrence is supposed to be 50% plus, or it is 50% or less, mind the slabs. Mind the slabs carefully. The probability is 50% plus, or the probability is 50% or less. If the probability of occurrence is 50 or less than 50, it is going to be called as a possible obligation. The obligation is going to be called as a possible obligation. And if it turns out to be a possible obligation, it will be called as a contingent liability to be disclosed in the notes to accounts only. So let's get this clear. Let me give you the chain. A company made a sale of laptops giving a warranty card. The company, on the basis of past experience, identifies that there is hardly any possibility that the customer will come to me. Is it a possible obligation? I put the facts again. A company made a sale of a laptop and gave a warranty card to the customer, and the company estimates that the possibility of the customer coming to me is less than 50%. Is it a possible obligation?
No, sir.
I said the possibility, the probability is below 50.
It is.
It is a possible obligation. The sale is made, a warranty card is given, which is an obligation, and my past experience tells me that the possibility of the customer coming to me is below 50. It's a possible obligation. I will only show a notes to accounts contingent. But if you say the probability is more than 50%, you go to step number 2. So I think the main concept is finding out the probability of occurrence of this obligation. So let me make one thing very clear. Is the past event should certainly create an obligation? Yes. Mind the words. Is the past event certainly going to trigger an obligation? Yes. And then I will find out the probability of occurrence of that obligation. That means an event is giving rise to an obligation, but the probability of that obligation getting triggered, if it is below 50, it is contingent, and if it is more than 50, we go to step 2. Then let's have a look at step number 2. In step number 2, we will evaluate that when the company will settle this obligation in the future. When the company will settle the obligation in the future, there will be a cash outflow. The company will have to incur money out of its own pocket to settle the obligation. So when they settle the obligation, there will be a cash outflow, and the standard requires again to make an assessment of the probability again. Everything in the standard is based on a probability. How are we going to assess the probability is what we're going to see in the questions, so don't get worried on that. You need to now see in step number 2 that when you settle the obligation, there will be an outflow. What is the probability of that outflow? If the probability of the outflow is 50% plus, or the probability is 50% or less. If it is 50% or less, it is a contingent liability, and if it is 50% plus, I'll go to step 3. I hope you got my step number 2 as well. The step number 1C is on the probability of occurrence of the obligation. And the step number 2 is on the probability of the outflow happening. Am I clear in step number 1C and step number 2? Subtle difference. Are you clear with that?
Yes,
Okay,
sir.
I'm getting a question. Will a contingent liability be created by default or only if the customer claims the warranty? You see, if you reach a conclusion that the warranty triggering is more than 50, create the provision, provided the second, third step is met. If you say that the probability of the obligation triggering is below 50, or even if it is 50, no provision, contingent. And finally, in terms of the step number 3, we need to put across a question: can I make a reliable estimate of the expected outflow? The company says that you will have to settle the obligation, so can we make a reliable estimation or not? If you say, yes, I can make a reliable estimate, I will create a provision. If you say no, a reliable estimate cannot be done, then it is going to be a contingent liability again. But let me tell you one thing point blank. The standard is very clearly said that the third step will always be a yes. It's a rare case, a very rare case, where the company says that I can't make a reliable estimation. So by default, when you look at the step number 3, you will always assume that a reliable estimate can be done unless the question is silent. And even in terms of step number 2, you will always assume the probability of outflow is more than 50. So technically speaking, my step number 2 and 3 is not really important from the examination perspective. In step number 2, if the question does not give you what is the probability of outflow, assume it to be 50% plus. If the reliable estimation is not given, assume it that you can reliably estimate. So my evaluation is basically going to be based on 3 steps only. I will basically evaluate in the question that there was a past event which is going to be creating an obligation, and if the probability is more than 50, effectively I'll create a provision. And if it is below 50, then I will say it's a contingent liability. Step number 2 and 3 is almost a mere formality. Got my point? Are we ready to go through some illustrations? You want me to first document the steps, or you want me to
Sure.
first take some illustrations with you?
I had a question.
Yes, please.
The contingent liability is created by default, or is it only when the customer raises a warranty issue?
No, it'll be created by default.
By default. Okay, thank you.
That means if you made a sale, you don't need to wait till the customer raises a claim. You need to make an assessment at the time of sale, the balance sheet date, the first year of the balance sheet date, take a call.
Got it. Thank you.
Okay, you want me to first make some notes to you on the 3-step model, or you want me to go to questions? Your choice. Okay, I'm getting notes first. So let's start writing the notes. You can start writing with me. So I am giving you now in detail KB's 3-step model. This is on the recognition parameter for IS 37. When do we create a provision, or when do we show it as a contingent liability? So we'll go to step number 1A. So first of all, in step number 1A, you need to first of all see, has the event already occurred? You need to see, is the event already occurred or not? You need to identify in the question what is the event. So the answer in this case is either a yes or a no. So the question rises, what is the event? I would say the event is something which triggers an obligation. Event is something which triggers an obligation. So you need to identify the event which is going to trigger an obligation for the company. If you say no, the standard is not applicable. If you say a yes, we go to step number 1B. Then we come to step number 1B. In terms of step number 1B, now we need to see, is there an obligation? So we need to see that, is there an obligation for the company? Underline the word obligation. So when you say obligation, there are only 2 types of obligations for the standard. The first kind of obligation is legal, and the other kind of obligation is constructive. There is no other kind of obligation. You need to carefully analyze the question, see, is the obligation legal or is it constructive? When you say it is legal, it is either by law or it is either by way of a contract. And when you say it is a constructive obligation, there should be acceptance of responsibility. There should be acceptance of responsibility on the part of the company, and it should create a valid expectation on the other party. So you need to see the 2 elements present. You need to see that the company, by a past practice, or the company by way of a published policy. So it could be a published policy, it could be a current statement, or it could be a past practice. They accept a responsibility and it creates a valid expectation. So when you say, is there an obligation? The answer would be a yes, or the answer would be a no. Any guess? If I say there is no obligation, what should be the course of action? Standard not applicable again. Because in this case, if there is no obligation, standard does not apply. If you say a yes, you need to go to step number 1C. Let me know if you're done. I'll come to the other steps as well.
Sir, 1 minute.
Yeah.
Sir, in valid expectation, it was past practice or public responsibility, or third one was?
Not public responsibility, published past practices, or you can say current statement,
Current.
or you can say it could be published policy.
Okay, sir. Thank you.
You're welcome. So the first step is on the event, the second is on the obligation. All right, if you're done, can I go ahead?
Yes, sir.
So let's have a look at step number 1C. In terms of step number 1C, we will look at the probability of occurrence. We'll look at the probability of occurrence of this obligation, and the probability of occurrence will be either we say it is 50% plus, not 50, or we say it is 50% or less. If you say it is 50% or less, then in that case, it becomes a contingent liability. And if it is 50% plus, you go to step 2, though technically speaking, it is going to be a case of provision effectively. Then we go to the step number 2, and in step number 2, we need to see probability of occurrence of cash outflow. Probability of cash outflow to settle the obligation. So we're looking at the probability of cash outflow to settle the obligation in future. So what is the probability of cash outflow to settle the obligation in the future? Here again, we're going to see the same probability. So either it is 50% plus or it is 50 or less. If it is 50 or less, it becomes a contingent liability. And if it is 50% less above, you go to step number 3. And I think worth making a mention that we will assume this by default. If there is nothing given in the question, by default, we'll assume the probability of outflow is more than 50. And finally, we go to step number 3. And in terms of step number 3, we will see, can we make a reliable estimate? Can we make a reliable estimate, underline reliable estimate of expected cash outflow? Can we make a reliable estimate of the expected cash outflow? And the answer would be a yes or a no. No is a very rare case. The companies generally cannot say that they cannot make an estimation. So if you say a yes, we create a provision. And if you say a no, then it is only a disclosure of a contingent liability. Right, so this gives us all the steps 1 ABC, step 2 and 3. Now we need to apply this to a couple of questions. So let me know once you're done. I'll bring you to the case studies.
So what is that in the step 3 after expected?
Cash outflow.
Okay.
I'll now share some case studies to you on the screen, and we're going to apply these steps on that.
So can you just give me 1 minute?
Yeah, just a second. Yeah. Let me know once you're ready. We'll start.
Yes, done, sir.
Okay, great. I'm now going to share some case studies to you, and we'll apply a step-by-step approach on these inputs. I'm going to share them on the screen to you. Is the screen visible? Can you see the illustration 1 warranty?
Yes, sir.
Just read the illustration, not the answer, just the illustration. I'll hide the answer as well. Just read the illustration. We are going to analyze this and fit it out here. Maybe you can take a screenshot as well, because these case studies I picked up from accounting standard, but very much relevant for IS as well. So I'll just give a reference and we'll take step number 1, step number 2, step number 3, and decide the remarks. So we are considering the step number 1, A, B, C, step number 2, step number 3, and we'll give the remarks in terms of provisions, contingent liability, whatever, and I'll just give a reference to the illustration number out here. Right? If you read the illustration, I think let me start the analysis. It says a manufacturer gives a warranty at the time of sale to purchaser of its product under the terms of the contract. Under the terms of the contract for sale, the manufacturer undertakes to make good by repair or replacement manufacturing defects that become apparent within 3 years from the date of sale. On the past experience, it is probable, more likely than not. When you say more likely than not, it means more than 50. The word probable itself means more than 50. There will be some claims under the warranty. So let's go one by one. Can you tell me in this example what is the past event which will trigger an obligation for the company?
Sir, sale of product.
Wonderful indeed. So I can say in this particular case, the past event is the sale. Great. Can you tell me what is the nature of the obligation? Is it legal or is it constructive?
Legal. Sir, legal.
And would you also like to help me that is this obligation something by way of contract or by way of law?
Contract.
Contract.
Yes, it's clearly given under the terms of the contract. So we can say that yes, it is a legal obligation, and I can say it is arising on account of a contract. Is there any probability of occurrence defined in the question? Is he telling me based on a past experience the probability of occurrence?
More than 50%.
Absolutely. It very clearly says that the probability of occurrence is more than 50. So which means it is 50% plus. Is the step number 2 and 3 relevant, or can I directly say a yes?
We can say yes, it's a
Yes, sir.
provision.
So I would say yes, step number 2 is met, step number 3 is met. So we can create a provision. I hope the illustration 1 is absolutely clear to everybody.
Yes, sir.
Wonderful indeed. I'm pretty sure you must be getting a little more hang with this illustration, and it must be very different from what you've done in financial reporting earlier. Is it so? What do I assume your silence to be? Did you say yes or no? Yes.
Yes, sir.
Great. Let's, I think, continue with more illustrations with you. Have a look at the illustration number 2. I guess I'll just show you in a single go. If you can, no, it's not possible. Okay, let me, before this illustration, also give you a little inputs now. The standard also gives a very interesting clarification that if there is no law as of now, but it is virtually certain. Virtually certain means that it is without any doubt that this will happen. So they say that if the law is not yet enacted, but we are pretty sure, we are virtually certain that the law will be enacted, you should consider it as good as a law. So the clarification is very interesting. They say that if the law is already in place, great. But if the law is not in place, but it is virtually certain without any doubt that the law will be enacted, you should consider it as good as a law. So let's keep this as a background as we read illustration 2. It says the enterprise in the oil industry causes contamination, but it does not clean up because there is no legislation requiring a cleaning up. And the enterprise has been contaminating the land for several years. On March 2005, it is virtually certain that a law requiring a cleaning up of the land already contaminated will be enacted shortly. Now, my question is, what kind of event will trigger an obligation in this case? What is the
Contamination.
event? Wonderful indeed. So I can say in this case, the company caused a contamination, and this contamination is something which will trigger the obligation to clean. And what is the nature of obligation in this case?
Legal.
Yes. And would you like to define
By
that
way
is
of
this
law.
legal by contract or is it legal by law?
By
Legal by
law.
law.
By law.
Wonderful indeed. And can you tell me that in this particular case, am I given the probability of occurrence or can I interpret it on a logical levels?
50% plus as it is virtually certain.
Correct. Because once the law is made, then I guess the probability of this obligation triggering is very high. I would say almost 100%, right? So logically, I can easily conclude that the probability of this happening is definitely more than 50, because once the law is enacted, which will catch people who have already contaminated the land, then I think the probability of this liability arising is more. Step number 2 and 3, of course, goes without saying is a yes. So what should I do? Create a provision. Did you get the hang of the second illustration as well?
So,
Hanji beta.
sir, over here, like we cannot estimate the provision, no?
Right?
No, over like in the exam there would be figures given for us to estimate the provision, no?
No, that's a measurement part. Let me tell you, there are two aspects. Right now, you're learning the art. Do we recognize a provision or not? The second aspect is, if yes, what is the amount of provision? That is a second area of discussions.
Okay, sir, understood.
Okay. So that was illustration 2. Let's take you to more illustrations. Let's take a little jump. Let's go to illustration 4. It says a retail store has got a policy of refunding purchase. And then it says by dissatisfied customer, even though it is under no legal obligation to do so. And the policy of making refunds is generally known. Is this refund policy like an acceptance of responsibility?
Yes, sir.
And when the policy is generally known, does this mean that it creates a valid expectations on the other party? Am I
Constructive
making sense?
obligation.
Yes. So can I say there is a constructive obligation? When you got a policy, it means accepting responsibility. It is known generally. It means that there is a valid expectation. Okay, now let's begin. In this particular case, can you tell me what is the event in the past which will trigger the obligation to refund?
Purchased by the customer.
Absolutely. Or we can say the sale by the company or the purchase by the customer, one and the same thing. That's right. And what is the kind of obligation? We've just seen it is constructive in nature. Has he given me anything about the probability of occurrence of this liability?
No.
Nothing is given. So now the question rises, how would I assess that part? Now please hear me carefully. I am now about to add a little dimension to the discussion. A little technical things, but please hear me carefully. I don't see that you will face a challenge on A and B. You're going to face a challenge on C only. I think after reading the illustration, you'll be able to easily identify that this is the event. You will be able to easily identify that this is, the obligation which is getting triggered, but the only concern is the probability of occurrence. I think now let's make it very clear. Is a legal obligation by force or by choice? I think I said that earlier as well.
By force.
Force.
And a constructive obligation is by force or by choice?
By choice.
By choice.
Can I say if a company has got a constructive obligation, there is no way the company will avoid it? Does that make sense?
No.
If I have a constructive obligation which I've chosen by choice, I will never avoid it. If the customer comes to me, I will not avoid it. Do you agree?
Yes, sir.
Yes, sir.
You see, because if it is by choice and I don't have to fulfill, it'll never create a valid expectation as well. So when the obligations are constructive, which means the company will never find out ways to avoid that obligation. So we will always assume that if the obligation is constructive, the probability is always more than 50. But when it comes to a legal obligation, do you think companies could try to find out legal ways of avoiding illegal obligations? Yes. For example, if you look at the law in Delhi, you cannot drive a car which is more than 15 years petrol version, you can't drive it on the road. So can I say what is the action I can do to avoid that obligation? I can sell the car before it completes a 15 years time. So I can by a future action avoid an obligation to trigger. So which means when your obligations are going to be legal in nature, you need to see that is there a way that you could legally escape them. If you could legally escape them, I would say the probability of occurrence is not more than 50, but it is below 50. Rather, I would say the probability of occurrence is not even there. But if the obligation cannot be avoided with any future action, I would say the probability is definitely more than 50. So I've given you some basic principles on step 1C. If your obligation is constructive, step number 1C, the probability is more than 50, undoubtedly. No need to assess. But if the obligation is legal, you will make an assessment that in this case, can you avoid the obligation by a future action? If you cannot avoid, the probability is not there. If you can avoid if you cannot avoid, the probability is more than 50. If you can avoid, the probability is not there. Did you get my point?
Yes, sir.
Now let me just revisit on the illustration 1 and on the illustration 2 and ask you, because probability was given, but let's say if the probability is not given, then what? I made a sale to a customer and I gave him a warranty. Do you think there is any way I could avoid this obligation? Can there be any future course of action through which I can avoid this obligation?
Yes.
How would you avoid it?
By not giving warranty card.
Changing the company's policy.
But if you've already given a warranty card, how will you avoid the obligation?
Changing the company's policy.
You'll change it retrospectively. People will sue you in the court of law. You can't change policies on a retrospective basis. If I made a sale to the customer, I gave him a warranty card. If I don't fulfill the obligation, he'll sue me in the court of law. Is there a way to avoid the obligation? No.
No.
You cannot. So the probability will be taken more than 50. Let's talk about the contamination of land. If the law of the land says that you contaminated the land, is there any way you can avoid obligation by future action?
Yes, sir. By selling the land.
तो बेटा लैंड बेचोगे तो जिसको लैंड बेचोगे वो क्या आपको पैसे नहीं लेगा आपसे?
By
मतलब वो आदमी पागल है जो आपको कहेगा हाँ मुझको लैंड दे दो, कल को गंद मचेगा मैं साफ करा लूंगा,
by
ये आपसे पैसे
cleaning the
मांगेगा
land,
भाई?
cleaning the land and
तो फिर तो
removing.
पैसे लग ही गए, तो ऑब्लिगेशन अवॉइड कहां से हुई? मतलब आप लोग लॉ को तोड़ने मोड़ने के लिए जो मर्जी कर दोगे। एक बार मुझे किसी ने वारंटी के लिए कहा सर मैं ऑब्लिगेशन अवॉइड कर दूंगा, मैंने कहा कैसे? सर आई विल सेल द फैक्ट्री। आई सेड ओ माय गॉड, you will avoid an obligation by selling your own factory? You're a great man. Your going concern assumption will go invalid. You will sell the factory just to avoid one obligation of the customer. That's not acceptable. I don't think so. There is any way you can avoid these obligations by future action. If you have given a warranty card, you are liable by contract. If you have caused a contamination, you have to do a cleaning up. There is no way you can escape. So it is going to be more than 50. Now you will say, sir, give me an example where I can avoid a legal obligation legally. Don't worry, on the way. Anyway, let's come back to this, the case of the constructive obligation, back to the constructive one 4. So can I say if it is constructive obligation, the probability is definitely more than 50. Step 2 is a yes, step 3 is a yes. So what do? We create a provision. If you notice something in these example, the focus is being legal by contract, legal by law, constructive, different kinds of obligations. Let's have a look at another illustration as well. Look at illustration 6. Have a look at illustration 6 and let's get your insights on that. The government has introduced a number of changes to the income tax system. And as a result of these changes, the enterprise in the financial service sector will have to retrain a large proportion of administrative and sales workforce in order to ensure a continued compliance with financial service regulation. There have been some changes in the income tax, and therefore you need to train your employees. If you don't train the employees, you will not be able to meet the regulations. At the balance sheet date, no training has been done. My question is very simple. Is there any obligation on the part of the company?
Yes.
What is the kind of obligation? Is it legal? Is anywhere it is given the law of the land tells me that I need to train these employees? Training is not the answer. My question is there an obligation of the company? What do you say? Is there any obligation of the company? I think some people are saying no, as there is no penalty. Somebody is saying a yes. I can
There is
understand. Okay.
there is no obligation as such, but in order to sustain, in order to be in the business, the company requires trained staff. So, like, there is no obligation, but it has to do that for its survival.
I like it. So now let me explain, as an employer, what I would do. I understand that I am in a catch-22 situation, that if I don't train the employees, I will not be able to meet the financial service regulation. Correct? That's what you're indirectly saying, that I'm in a situation that if I don't train the employees, I'm not able to meet the financial service regulation, right? You need to say yes or no, then I take it further.
Yes.
As you said, can I say yes in this particular case? If I don't train them, I am in a catch-22. So what? Somebody is giving me a very good offer. Fire them and hire new set of employee. I need to take a decision whether I train them or I go for new set of employees. But am I legally obliged to train them? I may be, I may be in a catch-22 situation where I need to train them because I am in a stuck-up situation. But I'm not legally obliged to train them. There is no legal obligation on my part, and nowhere it is written that in the past I've been training my employees. I don't have any kind of constructive obligation. So if there is no obligation, I'll do nothing. Did you get my point? You see, you need to be very clear. The question will be very clear whether the obligation is legal or constructive. If you notice in the previous example, in the first case, warranty, it very clearly said that you've given a warranty card. It's a contract. In the next example, it says the law is being enacted. In the third case, it was very clear that you've announced it and you say that it's your policy to refund and everybody is aware of it. But in this particular illustration, I am nowhere given. I might be in a majburi, I might be stuck up that if I don't train these people, I will not be able to comply with things. But that's okay. It's my choice that I will hire new set of employee. Maybe training them is a cheaper option. Maybe hiring new employees is a cheaper option. That is for me as an employer to evaluate, but I'm under no obligation to train. So in this particular case, I would say there is no obligation. And if there is no obligation, then in this particular case, I'll do nothing. I hope I'm clear with the picture, right? I am not going to say that there is an obligation just because I'm stuck up. Obligation means something which cannot be avoided under any grounds whatsoever. But in this case, I am under no such unavoidable catch. Right? Let's take it further.
So in this case, if there was a penalty due for non-compliance, then we would have to create a provision, right? Because then it would be binding on us.
Yes, but penalty for not training or penalty for non-compliance?
For non-compliance.
I will create a provision for penalty for non-compliance, not for training.
Okay.
That I would do, yes. And that would also depend upon, what are the chances of paying a penalty.
Yeah.
If I say the chance of paying a penalty is not there, I'll not create a provision. Okay, let's take it further. Let's come to another agenda as well. Let's look at 9B. Let's look at illustration 9B. A single liner, an airline is required by law to overhaul the aircraft once every 3 years. The airline is required by law to overhaul the aircraft once every 3 years. Is there an obligation?
Yes, legal
Yes, sir.
obligation.
Wonderful indeed. So I would say there is an obligation which is legal by law. And what is the past event in this case? Is it the purchase of aircraft?
Yes.
Can I say the purchase of the aircraft is the past event which would trigger the obligation? Now let me ask you something interesting. Can I sell this aircraft to avoid this obligation to overhaul? Can I say I could sell this aircraft and by the future action I could avoid this obligation? Yes, I can definitely sell one aircraft on a standalone basis, but I'll not sell my entire business to avoid an obligation. In the first example, you would not sell your entire business to avoid a warranty, but you could definitely sell one aircraft to avoid that obligation. Since this obligation can be avoided, you can avoid it by a future action, that is a sale of the aircraft. In this particular case, we'll do nothing. I hope the point is made very clear that you need to be very, very careful in terms of identifying obligation is there or not. And you need to be careful in terms of evaluating that if it is constructive, the probability is more than 50. But if it is legal, you need to work upon the fact that can you avoid the obligation? If no, it is probability more than 50. If you can avoid, I will not create a provision. Before I give you a small test now, I just want to make some few statements at this stage, and then I will take your test on this. Let me make a few statements, vouch me. If the company has got a constructive obligation, I will create a provision. Agreed. I'm looking at the essence of this entire analysis. If the company has got a constructive obligation, I will create a provision. Agreed. And that's right, I got the answer yes, makes sense. Next, number 2. Can I say if the company has got a legal obligation which cannot be avoided, I'll create a provision. Agreed.
Yes.
Yes.
Absolutely. Can I say if the company has got a legal obligation which can be avoided by a future course of action, I will not create a provision.
Agreed.
Yes.
Yes, sir.
This is the essence of the chart. Otherwise, I've given you the details, but this is the essence. You need to see the obligation is constructive. Effectively, you'll end up creating a provision. If the obligation is legal, and in this particular case, you say you cannot avoid, you'll end up creating a provision. And if you say you can avoid by a future action, you do not create a provision. You can see very clearly it's legal, unavoidable provision. It's legal, unavoidable provision. It's legal, avoidable, no provision. It is constructive, undoubtedly a provision. This is the essence of the concept. Testing time. I'm now going to give you a small little illustration which is to be evaluated for 2 different years, and you will tell me, do we create a provision or not? Goes for all of you. So let me just share this illustration number 8. Have a read on this illustration 8 and take a call. Do we create a provision for the 2 years or not? There are 2 different years. One is 2005 and one is 2006. You need to decide that do we create a provision or not. So make your analysis and get ready to answer the step number 1 ABC, the step number 2, the step number 3, and then we'll decide whether it is a case of provision or is it a case of a contingent liability. It says after a wedding, 10 people died, possibly as a result of food poisoning. Legal proceedings started seeking damages, but the enterprise disputes the liability. Up to the date of approval of financial statements, the enterprise lawyers advise it is probable they will not be found liable. But when the financial statements for 2006 is being made, the lawyers advise that due to developments, they will be found liable. The probability is they will be found liable. So I think let's put the questions back to you. You can decide the inputs. I think I've already got the inputs out here. Year 1 contingent, year 2 is a provision. And similar answers coming in. Let's, I think, go one by one. Let's put the questions to you and vouch me. Number 1, what is the past event in this case?
Food eaten by people.
Food poisoning.
So can I say the sale of the product is the past event? Is there an obligation, legal or constructive?
Legal by law.
Wonderful indeed. It is a legal obligation because when you are selling your product and people die of food poisoning, you're definitely liable. Okay, then let's consider the part number C. In the first case, it says the lawyers say it is probable we will not be found liable. So the
Contingent
probability of obligation triggering is below 50 or more than 50?
below.
Below 50.
Absolutely. If it is below 50, then what should I call this as?
Contingent liability disclosure in account.
Wonderful indeed. And in the next year, they say, the lawyer says that it is probable you will be found liable. So what is the probability of occurrence? More than 50% plus?
Provision.
Step number 2, of course, and step number 3 will be yes. So I am going to create a provision in the books of accounts. I hope I made myself very clear on my 3-step model how you are going to evaluate the concept of provision in the books. Right? So far, so good. Okay, now before we proceed further, I just want to get a quick assessment on your part regarding your comfort zone on a scale of 10 on the application of the 3-step model, because we've just seen the parameters to recognize a provision. We're yet to see how this provision is going to be measured. Yes, I'll give you a break as well, but before the break, just give me your scores on a scale of 10 regarding your comfort zone on the application of this 7-step, 3-step model. Let's start with a score of 7, 8, 9, 10, 10, 7.58. Okay, pretty great. I think majority is on an 8 or 8 plus. I think few have got a 7 as well. No worry, if you're on a 7, you need to do a little more working. If you're on an 8 or 8 plus, I think it's great. If you're 10, it's brilliant. So 8 and above is very good. 7, 7.5 means once you revise, you'll get the good hang of this as well. Okay, now I think it's time to give you a little break as well. So you need a break for what, around 10 minutes? Should do. Yes, I think a 10 minutes break would do. So maybe around 10 to 12 minutes. I'll join you in 10 to 12 minutes time. So enjoy a break. Then we'll discuss the concept of measurements with you. Okay, I'm closing the camera and the video for the time being. You can enjoy your break. Welcome back, friends. I guess we can start. Okay, I think there is a question. Let me first answer them. Sir, in illustration 9b, why can't we make a contingent liability? Well, in that particular case, if you can avoid a contingent, if you can avoid the obligation, why would I even say that the probability is, okay, let's put it like this. If the probability of occurrence is, remote, we don't even disclose a contingent liability. So we can say that there are three slabs. If you say it is more than 50, you create a provision. If you say it is 50 or below, but then there is two range in that. If it is remote, we don't even disclose a contingent liability. But if you say it's not remote, then you disclose. Now, in this particular case, in 9b, I would say the possibility is remote. If the company is already decided to sell the aircraft before 3 years gets over, then it is a remote possibility. Therefore, no disclosures will be done. Then there is another question which you said in illustration number 8. Step number 1C, when it is below 50 for 2005, will it be supposed to do nothing? No, no, no. You see, if you're saying that the probability, it's not probable, not probable means that the probability is below 50. Now, unless you tell me that it is remote, then I'll do nothing. But if you say it is below 50 and you're silent on the remote part, then in that case, a contingent liability will be disclosed. Right, I guess you got your answers. I think one was Sumaya and the other I think was V Sahana. Right, you got your answer. Okay, now let's take the journey forward. We've understood the parameters when a provision is taken or when a contingent liability is disclosed. We're yet to discuss about contingent assets. That we'll do later. Now the question is, if you say you need to create a provision, the second important aspect is how do you measure the provision? So we are now going to discuss the second area of discussion, and that is measurement of provision. How do you measure a provision? That is the agenda. Now, this is a very simple little exercise. I just need to give you some few key points on this area. It's a very simple area, but I just need to give you 2-3 major focus points on the measurement of provision. Number one, when you look at a measurement of provision, the first focus is the methods to calculate a provision. IS 37 has given us two methods to calculate a provision. The two methods which are given in the standard, one is called expected value method. We call it as EVM. So the first method is what is called expected value method, that is called EVM. And the second method is what is called MLO. That's called most likely outcome. It is called most likely outcome. So the standard has given us two methods in terms of measurement of a provision. One is called EVM, expected value method, and one is MLO. Now, before we come to how, which method is used when, first, let's understand how do we calculate a provision based on these methods. Like for example, in terms of expected value method, I say the outflow is going to be 2 lakhs. There is a 40% probability. I say the outflow is going to be 3 lakh. There is a 30% probability. I say the outflow is going to be 4 lakh. There is a 30% probability. So we look at the possible outcomes and we look at the probability attached to those possible outcomes. So what we do in this particular case, we get the possible outcomes and the probability attached, and you just need to take a simple, you can say a weighted average of this. So when you say expected of course means that you need to consider a weighted average of the possible outcome, as simple and straight. So let's see how much does it turn out to be. 2 lakhs with a 40% chance, 3 lakh with a 30% chance, and 4 lakh with a 30% chance. I guess it comes to 2.9 lakhs. This is called expected value method. Now let's see what is a most likely outcome. Let's say, for example, the provision will be, the outflow will be 2 lakhs. There is a 70% chance. The outflow will be 3 lakh. There is a 30% chance. Can you tell me, out of the two possible outcome, which one is more likely to happen? Is it 2 or is it 3?
Sir, 2.
That's right. So I will create a provision to the extent of 2 lakh rupee. Whosoever probability is more, you select that option. Now you would have noticed something, but I want to still make it very clear. In an expected value method, the probability is got a role in terms of measurement. But in terms of most likely, the probability is only got the role of selection. You are considering that the probability is 70, but the provision is 2 lakh. The probability is not coming in the calculation of the measurement. I hope you got my point. In an expected value out method, you are considering the probability as a weight. But in this case, the measurement is only based on whichever has got more probability, you say this is the answer. So your probability is not being considered in the calculation process. Am I clear with the concept, right? You got my point? Okay. Now the $1,000,000 question, what comes to the mind is, which method is to be used when? We understood EVM, we understood MLO, but which method is to be used when? Now, the standard is very clear on the picture that expected value method will be used in those cases where you can say there is a large okay, I think it was stuck up better. So EVM will be applied when your obligation is owed towards a large population. We use an EVM. But MLO will be used when your obligation is owed towards a single customer. When your obligation is a single customer, then I am going to use a most likely outcome. Let's say, for example, my company is selling a tailor-made products to different customer. What do you think I will use which method to create a provision? Some trouble again. Okay, so let me come back to the point. Let's say, for example, I am looking at a company which is selling tailor-made products. What do you think, which method will I choose if I am selling tailor-made product to different customer?
EVM.
Tailor-made means that I have single customers and different products made to single customer. I think MLO makes sense. But let's say, for example, my company is selling, let's say, laptops like Lenovo to a larger population, then it is going to be EVM. So if you owe your obligation towards a standalone customer, MLO. If you owe your obligation towards a larger population, then it is expected value method. Got my point? Okay, this is number one. Let's now see more aspects in terms of measurement. Number two. The second question what comes to the mind is that when a company is creating a provision, am I supposed to consider time value of money? The question arises, do we consider a time value of money or not? For example, let's take a very basic example. Let's consider a time scale, and let's say this is the balance sheet date and your liability is expected to occur 2 years later. I know that my cash outflow is going to happen 2 years later, and let's say that I am expecting that the outflow is going to be, let's say, 1,21,000. The question rises, do we create a provision to the extent of 121, or do we create a provision which is the present value of the expected outflow? The standard makes it very clear, if the time value money is material. How do you decide that time value money is material? If the time gap for the payment is more than a year, I'm creating a provision and I know that the payment is going to be made, let's say 12 months later, the time value money is considered material. In those cases, the provision will be taken at the present value term. So we can say the concept of time value money becomes relevant only if it is material. And how do you say that the amount is material if the period is exceeding 12 months time? If I know that the amount to be paid is going to be paid 12 months later, then the time value money becomes relevant. Now, let me also give you a very important concept in IFRS. What I'm about to tell you is something which you will see in the entire subject on SBR. This is a very crucial concept, and this is going to be something which is extensively used in many standards. Let's take the same example and give you the concept which will apply. So let's say I come back to the example. I want to create a provision. I know that I'm going to pay the money after 2 years with an expected outflow of 121. So what I need to do when I create a provision today, I need to create a provision based on the present value of 1,21,000. And of course, for this, I need a discounting rate, which will of course be given in the question. So let's consider the discounting is at the rate of 10%. So I will discount this at the rate of 10% for a period of 2 years. Can you tell me what is the present value?
One lakh.
Discount this, that's 1 lakh. Okay, so we get the present value. This is 1 lakh. Now, see carefully the sequence of entries we are going to pass at the end of each year. At the end of the year, that is on the balance sheet date, I will put the entry profit and loss account gets a debit and the provision gets a credit. And this entry will be recorded at the present value terms, which is 1 lakh rupee. Now, let me tell you something important. In the entire IFRS, if you consider a present value, mind the hands direction. In IFRS, if you consider a present value, trust me, if you are doing a discounting today, you are going to do the compounding in the future years. I put it again. In entire IFRS, if you notice at any place in any standard that you are considering a discounting, because when you take a present value, you are doing a discounting. So what am I supposed to do in the future year? I need to do compounding, and that is basically called unwinding of discount. So in this example, I took 1,21,000 and I took the present value, which is called discounting. Now, what am I supposed to do in the next 2 years to come? After year 1, after 1 year, what we will do, we will unwind the discount, we will do the compounding. The journal entry for the unwinding is, I'll put the entry finance charge gets a debit and the provision gets a credit, and we will compound at the rate of 10%. 1 lakh rupee is now going to be compounded at the rate of 10%, and we will record an interest of 10%, that is 10,000. A similar entry will be done at the end of another second year as well. So after another 1 year, that is after 2 years, a same entry will be repeated again. Now your provision is 1 lakh plus another 10, that makes it 1 lakh 10. So on 1 lakh 10,000, we take a 10% interest, that comes to 11,000. So this is a principle which you're going to see in entire IFRS. Anytime you consider a discounting, you pass an entry at a discounted value, you are going to see that there will be a compounding which is called unwinding of discount. The entry for the unwinding is going to be finance charge debit and the provision gets a credit. So automatically you will see after the end of 2 years, the provision will accumulate to 1,21,000 itself. So this entire concept is called UOD. It is popularly called unwinding of discount. So remember, this is going to be something which you're going to see in almost all these standards. Anywhere you consider the present value, that means you consider a discounting, you're going to see in the future years a compounding which is called unwinding of discount. Did you get my concept clear? Is the concept of UOD unwinding clear, I guess?
Yes, sir.
Yes, sir.
Okay, perfect indeed. So this was the second inputs as far as the measurement of provision is concerned. So I've given you two inputs. One is the method, which is EVM or MLO, and the second is the time value of money. Let's now give you more inputs as well. I'm now going to give you two situations and we will analyze what is the amount of provision which should be created in the books of accounts. So let's give you two situations in this case. Let's consider a situation number one and let's consider a situation number two. Let's say a company A and B are jointly and severally liable for an obligation. Let's consider a company A and B are jointly and severally liable for an obligation. And they decided that they will bear this obligation in the ratio of 60% and 40% respectively. So when I say jointly and severally liable, it's more like a partnership firm where the partners are jointly and severally liable. That means if one of the partners doesn't pay, the other partner becomes liable. So in this case, they are jointly and severally liable. Now let's consider I applied my methods and we decided the provision to be created is, let's say, 10 lakh rupee. Would you like to help me? How much provision will A and company B create in the books of accounts? 10 lakh is the total liability and they've decided to bear the obligation in the ratio of 60 and 40%. So would you like to define how much is the provision which A and B will create in the company? I get the answer 6 lakh and 4 lakh. That's right. So the provision to be created is going to be 6 lakh and 4 lakhs in this particular case. Is there anything else which company A is required to do? Or is there anything else which a company B is also required to do? Remember that A is creating a provision of 6 lakh, which is his own share. Is A also required to create a contingent liability for the portion for which B is liable? Am I making sense? Yes. So in this case, A is also going to show the liability provision of B as a contingent. Similarly, B will also show the portion of A as contingent, because if B doesn't pay, the liability of A will trigger. And if B doesn't pay, A doesn't pay, the liability of B will trigger. So A will create a provision for his share and he will also show a contingent liability for the other party's share. Makes logical sense. Let's have a look further on a second situation. Let's say there is a company X Limited and it has got a customer, let's say A Limited. And let's say it has also got B Limited as a supplier. So company X Limited has got a customer Oh, somebody's taken the rights or something. What is this happening? Are you all again muted back, I guess?
No, sir.
Okay, something funny. Video stopped suddenly. Okay, let's come back. So in this case, I said the customer A sued the company X and the company made an estimation that they are liable to pay,
Sir,
let's say, a 5 lakhs provision. Hanji beta.
can you repeat this once again? Actually, I missed it. The video has been stopped.
Okay, I'm just putting the facts again, no worry. So what I'm saying in this particular case, there is a company X, they've got a customer A, and they've also got, let's say, a supplier B. Now, the customer filed a court case against company X, and the company AX also filed a counter case against the supplier, telling him that you are responsible for the court case by my customer. So our estimation tells us that as far as the customer's court case is concerned, the company is liable to pay 5 lakh. So we need to create a provision of 5 lakh. And we also make an estimation that X is going to get a claim from the supplier, which is to the extent of 3 lakh. Now the question arises, what is the amount of provision which the company should create? Should it create a provision of 5 lakh rupees, or should it reduce the amount of 3 lakhs claim and create a provision of 2 lakh? What is your inputs on that? Do we create a provision of 5 lakh rupees, or do we reduce the amount of claim and create a provision of 2 lakh? Because my ultimate outflow is going to be 2 lakhs in this case.
Create a provision for 5 lakhs.
Provision of 5 lakh.
That is correct. The standard is very clear on the agenda that if you are going to get a reimbursement of your claims, you are still going to create a gross provision itself. If there is any kind of counterclaim which you can get, in this particular case, this can be treated as a separate asset if you know that it is virtually certain to be received. Virtually certain means that you are absolutely without doubt clear that you're going to get this money. So the standard makes it clear in this particular situation, the company is going to create a gross provision only. I cannot reduce the amount of 3 lakhs from the amount of provision. The reimbursement is to be treated as a separate deal altogether. So for this 3 lakh rupees, the company can create a separate asset in this case, and that also provided it is virtually certain. I'm putting it as VC, that it is virtually certain. The reimbursement amount cannot be taken as a reduction to the amount of provision. If the company is going to get a reimbursement, you need to treat this as a separate asset. The provision will be unaffected. And another important input, the asset which you are going to create cannot exceed the amount of provision. So the amount of asset which you are going to create, it cannot exceed the amount of provision. It is not possible that the company creates a provision of 5 lakhs and you create a reimbursement asset more than 5. You cannot show an asset more than the provision. The benefits cannot be reflected. So even if you can get a counter claim of more than 5 lakh rupees, your reimbursement asset will be restricted only to the extent of 5 lakh. So this is the situation number 2. I hope I made myself clear. Contingent asset, somebody is saying for 3 lakh. Well, I will not say that it is a contingent asset. I'm saying if it is virtually certain, it will be reflected as an actual asset. Contingent means that if it is not virtually certain, then it would be reflected in the notes. So that's the reason I've said that if it is virtually certain in nature, then it gets reflected as an actual asset in the balance sheet of the company. But if you say that it is reasonably certain but not virtually certain, then in that particular case, it appears in the notes to accounts, right? So that was a third aspect. So I've given you 3 inputs on the measurement of a provision. Number 1, I said the first aspect is the method. The second is the concept of time value money, and the third is the 2 situations. Number 4. What about a provision for future operating losses? A company is expecting that there will be future operating losses. Can the company create a provision for any future operating losses? The standard makes it very clear, no. The past event is not yet occurred. So if the company is expecting any future losses, you cannot create a provision. So as far as future operating losses is concerned, no provision can be made. We cannot make any provision for future operating losses, and the logic is fairly simple, that in this particular case the event is not even occurred, the losses have not even occurred, so you cannot make any provision for any future operating losses. Okay, so this is one inputs on the measurement of provision. Now comes another interesting area. I've given you the measurement, I've given you the inputs on the recognition parameter, the 3-step model. I've given you the inputs in terms of measurement of a provision, and now I need to give you the exception when the 3-step model fails. I'm now going to discuss the area when the 3-step model fails, and the standard says even if the 3-step model fails, you are still required to create a provision. So I'm now going to work upon the exception of the 3-step model. So we've got an exception. We've got an exception to the 3-step model which I gave you. That means, in spite of the fact that the 3-step model fails, I am still required to create a provision, and this exception is called technically onerous contracts. This exception is called an onerous contracts. Now you've got a choice. You want me to explain this in technical language or tell you in simple words what is the concept of an onerous contract? You want me to use technical language, or you want me to first give you the insights in a very simple terminology that what is an onerous contract?
Simple.
Okay. So let's understand the concept of an onerous contract. I'll give you an example, watch this carefully, and then I'll give you how you need to decide a provision will be created or not. Let's take an example to understand this. Let's consider there is a company A Limited, and it entered into a contract with B Limited. A company A entered into a contract with B Limited, and it entered into the contract to buy 10,000 units at the rate of 15 rupees per unit. The company A entered into the contract with B that he wants to buy a total of 10,000 units at the rate of 15 rupees per unit. Actually, company A was thinking that he's going to trade in these items. He thought he will buy these items at 15 and sell them at a profit. So the intention of A was merely to trade in these items. He thought he'll pick them at 15 and then sell them at a high rate and pocket a difference. Unfortunately, what happens that the current price at which A can sell, let's say the current price at which A can sell is to the extent of 12 rupees per unit. Do you think A is interested in buying these items now? Because if the current price is at the rate of 12, do you think he would be interested in buying these items? And that's rightly said. Of course not. If he's going to buy at the rate of 15 and then he's going to sell at the rate of 12, he is going to suffer a loss. He is not interested, which means if he executes the contract, let's say if he still executes the contract, can you tell me what will be the loss he will suffer on this contract? If let's say he says, yes, I will still execute the contract, what is the loss he's going to get on this contract? That's right. 3 rupees per unit into 10,000 units, he will get a loss to the extent of 30,000. Let's say B Limited also told him, B Limited told him that if you fail to execute the contract, you need to pay me a penalty, let's say to the extent of 50,000 rupees. B Limited at the time of entering the contract told him that if you will not execute the contract, you need to pay me a penalty of 50,000. That means if A executes the contract, he gets a loss of 30. And if he does not execute the contract, he pays a penalty of 50. What do you think is a better deal for him? Should he execute and suffer a loss of 30, or should he walk out of the contract and pay a penalty of 50? What is a better deal?
He should execute.
Makes sense? So can I say in this particular case, he is in a stuck-up situation. That means if you execute, you are at a loss. If you don't execute, you are still at a loss. These kind of contracts are called onerous in nature, which means a contract which is onerous is got to be you execute, loss. You don't execute, penalty. If both the factors are present, it is onerous. If any one factor is missing, it is not onerous. Mind the words carefully. If you execute, you should get a loss. If you don't execute, you pay a penalty, then it is considered onerous in nature. If any of the condition fails, it is not onerous. Let me put that question to you. Let's say in a contract, if you execute, there is a loss, and if you don't execute, there is no penalty. Is it onerous?
No.
No.
That's
No,
right.
sir.
Let's say, for example, you enter into a contract. If you execute, there is a profit, and if you don't execute, there is a penalty. Is it onerous?
No.
No,
No,
sir.
sir.
That's right. So can I say for a contract to be onerous in nature, what is important is what I always tell people. Let me put it like this. एक तरफ कुआं, एक तरफ खाई, किधर जाऊं मेरे भाई? So which means that if you execute, there is a loss, and if you don't execute, there is going to be a penalty. Either ways, you are at a loss. So the standard says that you need to create a provision. You need to create a provision for the lower of the two. That means in this case, I'll create a provision to the extent of 30,000. By the way, why am I saying that it is an exception to the three-step model? Can I say the event is not yet occurred? In this particular case, when you enter into the contract which is yet to be executed in the future, the past event is not occurred. So if I apply a three-step model, in those cases, a provision will not get created. So the standard setters decided that if a company is entered into any kind of future contracts, you need to basically evaluate that in terms of those futures contract. If you know that you execute, there is a loss, and if you don't execute, there is a penalty, it is an onerous contract, and you need to create a provision for the lower of the two, because you would prefer the course of action where the penalty or where the loss is less. Did you get the essence?
Yes.
Yes, sir.
So let me just make some notes on this. So we can say in terms of onerous contract, contracts which are yet to be executed, contracts which are yet to be executed in the future. So we need to first of all identify that there are contracts which are yet to be executed in the future. There will be a loss on execution. there will be a loss on execution, and there will be a penalty on non-execution. So both the factors need to be met at the same time. So you need to first of all zero down that the contract is yet to be executed in the future. That's one. And there is a loss on execution and penalty on non-execution. So this implies it is an onerous contract. This implies that it is an onerous contract. And therefore, in this particular case, we need to create a provision. We need to create a provision which is the lower of the two, the penalty or the loss, whichever is less. So we need to create a provision for the lower of the two, the penalty or the amount of loss, whichever is less. Right, so this is the exception as far as the three-step model is concerned. Now I need to give you a little inputs about the contingent assets. Rest all is done. I have covered the aspect of provisions and contingent liability. We've done the three-step model. We've done the exception to the three-step model, and we've done the considerations applicable to measure a provision. So let me know if you're done, then I will take you to the contingent assets now. Right, I guess everybody done. Can we go further?
Just a minute, sir.
Yeah, sure.
So done. Thank you.
Okay. Now let me come to the last agenda on this standard, and that is contingent assets. That is called contingent assets. Well, first of all, when you look at the concept of a contingent asset, just like a contingent liability is a possible obligation, a contingent asset is called a possible asset. So when I say that there is a contingent asset, we are looking at that it is supposed to be a possible asset. Now I'll take a simple example to illustrate the various permutation combinations which could arise in terms of a contingent asset. Let's consider a company sends its goods through a railway authority and the goods damaged in transit. The company has sent the goods by railway and the goods get damaged in transit. And the company puts an insurance claim. So I am now looking at that there is an insurance claim which the company puts against the railway authority. So the company sends its goods and they get damaged in transit, and the company puts an insurance claim against the railway authority. Now we're looking at three permutation combination. The first input is the insurance claim is accepted by the authorities and it is formally communicated to you. The insurance claim is accepted by the railway authorities and it is formally communicated to you. Can I say it is virtually certain that you will get this money? They accept the claim, they formally communicate to you that we've accepted the claim. Is it virtually certain that you're going to get this claim?
Yes.
Definitely yes. In this particular case, I will reflect it as an actual asset in the balance sheet of the company. It is no longer contingent. It is no longer contingent. If the claim is accepted and it is formally communicated to you, it is undoubtedly an actual asset. It will be reflected in the balance sheet as an actual asset. It is not contingent. Next. Let's say, for example, the claim is accepted but not formally communicated. You come to know through your sources that the claim is being accepted. So you come to know the informal channels. You come to know informally that claim is accepted. It's an informal communication that the claim is being accepted. In this particular case, can I say in this particular case, I should recognize it as an asset, or I should disclose it in the notes, or I should not do anything? I have got a informal communication that yes, the claim is being accepted, but not any formal communication. Can it be reflected as an asset in the balance sheet? Undoubtedly no. In this particular case, you can call this as a contingent asset. In this particular case, you can call it as a contingent asset, and it can perhaps be disclosed in the notes to accounts. Though practically, if you ask me, this is again going to be challengeable. Because if the company has got any such claim where there is an informal acceptance, it's going to be against the concept of prudence to reflect it in the notes. But if you are virtually certain that yes, this claim will be collected, in that case, you can definitely make it a subject matter of notes to accounts. Let's look at a third situation. Let's consider that there is no communication. There is no communication at all. No formal acceptance and no informal acceptance. What should be the course of action in this case? I did not get any formal acceptance. I did not get any informal acceptance either. What do you think I should do? Recognize the asset in the balance sheet? Of course not. Show it in the notes to accounts? Of course not. In this particular case,
Do
the
nothing.
best strategy would be yes, to do nothing. So we can say the contingent asset is typically in the middle situation. When the company is got an information on an informal level and they're virtually certain that they might get this claim, and the certainty is virtual, you can show it in the notes to accounts. Because if you've already got a formal communication, it is no longer contingent, then it is actual in nature. But other than that, you cannot reflect a contingent asset in the balance sheet or in the notes to accounts. Right? I hope I'm very clear with the concept of contingent assets as well.
Yes, sir.
Wonderful. So there is now another small little aspect which is there, which I want to give it to you for reading. Otherwise, my standard is done. I have covered the aspect of provisions, their recognition, their measurements, the contingent liability, as well as the contingent asset. Now, there is a small little area which is given in the standard, which is in terms of what we call restructuring. So in terms of restructuring, the parameter is the same, but let me just give you a little brief, and then there is just a little page which is given on restructuring, so you can just have a little read on that area. Sometimes the companies change the way in which they conduct the businesses. Let's say, for example, from a labor intensive, you are trying to become machine intensive. So what the company would do, they might, retrench a lot of employees. And when they're going to retrench a lot of employees, in those particular cases, the company may plan to compensate the workers. This is called restructuring, which means the company changes the way the business is conducted, and therefore you want to give a compensation to employees on account of restructuring. The standard makes it very clear that the company's obligation is going to trigger only if it is constructive in nature. Because many times the company may not be under a legal obligation to give this compensation. The company on its own free will may like to give a compensation. So when does the obligation trigger? If it is a constructive obligation and it is formally communicated to the employees affected, the company would create a provision for this restructuring. Now, what you need to basically read is there is a list of items given that what amount can be created as a provision and what amount cannot be created as a provision. So I just want to give this small little homework to you just to have a little read on the area in terms of restructuring. First of all, they'll explain you what a restructuring is, for which I've just given you very basic input. And then based on that, they've given you that only expenditure which are directly related to restructuring, you can create a provision in the books. So they're going to list of what is included in the provision and what is excluded in the provision. So this is one area where I want to do a self-reading. If still you face a challenge, I will take that up, of course, in the next class, but at least you can first give a reading and I'm pretty sure you'll understand this bit as well. Other than that, my standard IS 37 is over on this. Okay, so I think any questions on your mind on IS 37? I'm not planning to start something new at this stage. I don't want to start a new standard in the last 10-15 minutes. So any questions on your mind on the standard? Otherwise, we are done with the standard. So can you explain the contingent assets part again? Okay, let me put this once again. First of all, let's understand what is contingent. Now, when you say contingent, it is dependent upon certain events which may or may not take place. Please hear this carefully. When you say it is a contingent asset, it means certain events, certain things which are dependent upon certain events which may or may not take place. Now, my question to you, number one, if the insurance company has accepted the claim, is it now dependent upon any ifs and buts, or is it confirmed? If they've accepted my claim, is there any event which will decide the fate, or is it confirmed? Yes, it is confirmed. It's no longer contingent. It is only contingent if it is based on ifs and buts. Now let's look at the next situation. If the claim is accepted but there is no formal communication, do you think the chances are that your sources could go wrong? Is it again something which may change? If you get a formal communication, you're pretty sure you're going to get the money. Then it's not contingent, it is actual. But if there is no formal communication, can I say things could undergo a change? It doesn't make sense that you reflect the asset in the balance sheet, but if you're virtually certain, without any doubt, that you will get this money, you can only make it a subject matter of disclosure, but you cannot record it in the balance sheet as an asset. Got my point? And finally, if there is no communication, no formal, no informal, I think it's going to be dangerous that you capture it in the books, either in the form of notes or in the balance sheet. Then I think the best course of action would be to do nothing. Right? Did you get your answer? So what is the invalid expectations in, it's not invalid, it is valid expectations. In a constructive obligations, I said there is a valid expectation. I say something and the party which, I tell the other party, he feels if he says, he'll do it. So if I accept a responsibility and the other party hearing the obligation says, yes, he says he'll do it, it creates a valid expectation. As I said, if I tell you I make you an SBR expert, I am accepting a responsibility. If by hearing the statement, your expectations arise, that he is saying he'll do it, it's a valid expectation. If your expectations do not arise, then in that case, a valid expectation don't get created. So the other party, when he hears the responsibility, he feels that yes, this will be done, it creates a valid expectation. So can you explain the onerous contract with a help of a time scale? Well, onerous contract doesn't have a time scale like the other one. Onerous contract is something which is a contract yet to be executed. If it is yet to be executed, you can't have a time scale. Here the concept is you entered into the contract which is yet to be executed. The event has not yet occurred. And if the event is not yet occurred, as per the 3-step model, your step number 1A will fail. But since I know that if you're going to execute the contract in the future, you'll get a loss. And if you don't execute the contract, there will be a penalty. You know that there is going to be a loss in either way. Which means the contracts which are yet to be executed in the future, and you know that there will be a loss if you execute and there will be a penalty if you don't execute, which means losses on both sides. In those cases, when you know the losses are definitely bound to happen, it makes logic that we create a provision, and of course for the lower of the two. Because if you know that you'll get a loss on execution and a penalty on non-execution, I will choose the route which is going to result in lesser losses. Right? You're welcome. Right, I think that answers the questions as well. And there's another one. So how to practice the questions? Are they available on LMS? Yes, you can now practice the questions on IS 10 as well as on IS 37, both from Zell LMS as well as from the ACCA Study Hub as well. I think the questions on, to my knowledge, on the ACCA Study Hub is definitely there. So you can definitely try questions now on the Study Hub. In the meantime, of course, in the next week, I'll try and give you the Excel sheet for the Kaplan questions as well. And then you can try questions from that area as well. So do try questions from the LMS, the Zell LMS and the Study Hub on IS 10 and 37 both. Right, friends, I think that seems to be all the questions for the day. So I think that's all for the day. I'm going to start my next set of standards in the next class with you. So see you on the next Saturday. Thank you very much. Bye-bye and take care.
Thank you, sir.
Thank you very much. Thank
Thank you,
you.
sir.
Thank you, all of
Thank you,
you.
sir.
Thank you, sir.
Thank you.